So we just finished going through T1 Energy's 2026 Q1 earnings call materials, and now we want to share our takeaways with you. Here's the thing. The story is gorgeous. The bridge is beautifully drawn, but the whole thing hangs on two screws that are not bolted in yet. One is a $350 million funding hole. The other is a tariff ruling still up in the air. Can the money show up? Can the wall hold? Over the next 3 pages, we pull each screw apart, one at a time. The company frames it like this. 2025 was the year they poured the foundation, 2026 is the bridge year, and 2027 is when they intend to deliver a real step change in earnings and cash flow. The filing shows the fourth quarter hit production and sales above 1 GW for the first time. And they pulled in over $440 million to transform the balance sheet. Pretty numbers, no argument there. But I'm telling you, the whole story lives or dies on 2 screws sitting right in the middle of that bridge. One screw is G2, the cell plant, still short $350 million to reach financial close. The other is the Section 232 tariff ruling, still pending, still hanging out there with no decision. Our read is simple. Until those 2 screws are bolted in, every 2026 growth narrative is just an unproven option, so don't bank it yet. What does this company actually do? The fastest way to get it is to think about bread. Polysilicon is the flour, the solar cell is the dough, and the finished solar module is the loaf coming out of the oven. The company stated that in the past, the US side mostly just baked the bread. The plants did final assembly, and the dough, the cells, came almost entirely from imports. That's the offshore risk they flag. So what's the ambition here? They want to start from domestic polysilicon, mill their own flour, knead their own dough at the G2 cell plant in Texas, then bake the bread at the G1 module plant in Dallas. The whole chain, end to end, inside the wall. Our take is blunt. This is a play to own the entire chain, and whoever's still leaning on imports gets shut out. Now look at how the 2 plants split the job. The company stated G1 buys the ticket into the market, and G2 is the one locking down the real profit. G1 in Dallas is a 5 GW module plant fully operational, and the filing shows it produced 2.79 GW, even pushing past nameplate daily run rate in the fourth quarter. Its role is simple: chase volume and market share, get into the utility scale game. G2 in Austin is still under construction, 5.3 GW total, split into 2 phases, phase 1 at 2.1 GW and phase 2 at 3.2 GW and up. The company expects first sales late 2026 and expects G2 to become the main engine for margins, earnings and cash flow once it launches in the fourth quarter of 2026. I'm telling you, the division is crystal clear. G1 holds the line on volume, and the real profit, the part that's supposed to rip, sits in G2, and that's exactly where management placed its bet. Lower your voice for this one, because this is the whole game. The company stated the rules flipped on January 1st, 2026, with OBBBA putting content and equity restrictions in place. Anybody tagged as a FIOC entity, a foreign entity of concern, gets hammered, locked out by those content and ownership rules. And alongside that, the Section 405X tax credits reward domestic manufacturing with the transition period secured through certified non-FIO cell supply. So where does T1 Energy sit? It sits inside the wall in the dividend zone. Here's the key thing. The company stated that whoever builds compliant domestic capacity inside that wall gets to dictate market pricing. Our read is straight. The height of this wall matters more than how fast they pour concrete, because that wall is the thing handing them pricing power and tax credits they can turn into cash. The company laid out a 2025 scorecard with 4 checkmarks, and these are real, not fluff. First, operational scale up. The filing shows G1 ramped from initial production all the way to full utilization in about 12 months. Second, subsidy monetization. They verified that 405X credits convert into cash, selling the first batch to a US financial institution. Third, the supply chain backbone. The company announced partnerships with Hemlock and Corning on polysilicon, plus NextPower, locking down the upstream. Fourth, mega offtake execution. They signed Treaty Oak Clean Energy, a 3-year 900 MW deal using G1 modules and G2 cells, delivering from 2027. So the base is built, no doubt about it. But here's the question that suddenly matters, and the company asks it itself. Where does the capital for the superstructure actually come from? Where does the money come from? This is the Lifeline page. The company announced the fourth quarter raise totaled over $440 million. Break it down. The biggest slice is $322 million in gross, common stock plus convertible debt, closed in December. Then $72 million in direct common stock issuance and another $50 million in convertible preferred through founding investor and Compass Capital. So did the stock rip? The filing shows market value expanded more than 11 times from the spring 2025 low to year end. 11 times. Yeah, that'll turn heads. But we want you to cool it for a second. Our read is this, that LFX is not earnings driving a revaluation, it's capital availability snapping back off a near-death highly distressed base. The balance sheet is genuinely transformed, but the multiple deserves strict scrutiny, so keep your eyes wide open. Let's get into why EBITDA missed, because the filing lays it out as a waterfall, top guidance falling step by step down to the actual number. First cut, the company stated net sales took a $38.7 million hit in total. Inside that, $16 million came from clearing inventory into a weak market just to preserve 45X eligibility. Second cut, $21.7 million from offtake true up adjustments. Third cut, $15 million from tariffs on imported sales coming in higher than expected. There's also a $34 million sales commission waiver, and the filing shows accounting rules wouldn't let them reverse it through the P&L, even though cash flow benefits. That last one is pure accounting noise, no cash damage at all. I'll read, strip out the noise, and the real pain is those 3 cuts, and the company is calling them one-time pre-OBB adjustments, so whether you buy that is on you. Engine number 1 is about the quality of the revenue, not just the size of it. The company stated they're carrying a 3GW signed backlog into the year, more than double what they had a year ago. Break it apart. 1 GW sits in cost plus contracts, 5-year long-term deals, highly visible, and used directly to underwrite the debt financing on G2. The other 2 GW is fixed margin contracts, 1-year deals, driving immediate profitability. Here's the shift that matters. The company stated they're moving away from a low visibility agency sales model into high margin, self-owned contracts. Our read is they're using that 5-year stable backlog as the credit support to fund G2. And that's a sharp move. But don't lose the thread. 3 GW signed is nice, but it's still short of the capacity number they're guiding to. And we'll do that math next. Engine 2 is a great big 41 GW funnel the company is putting on the table. Let's be clear right away. The company stated this entire 41 GW is still uncontracted, all of it in discussion. Up top 18 GW is mid-term discussions, the middle 13 GW is merchant sales opportunities, and the bottom 10 GW and up is advanced offtake talks with major utilities and developers. Pay attention here. The company flagged that this 41 GW funnel is distinctly separate from the 3 GW signed backlog, so do not stack them together. The funnel is wide, sure, but how much actually converts is still unproven, and that's the company's own caveat. They named 3 catalysts, post-July 2026 safe harbor milestones lifting second half inquiries, a strong preference for high efficiency to-upon sales, and proven 45X credit monetizability. I'll read, a wide funnel is a story, conversion is the proof, so wait for it. Engine 3 is about margin coming from outside the core business, and there are 2 pathways. Pathway 1 is contract shedding. The company announced they're exiting the China service and licensing agreement, feeding straight into an SG&A reduction. The company put the annual savings at $30 million to over $100 million. Mind the range? $30 million is the base at 3 GW with no G2 sale, and $100 million plus is the high end at 5 GW including a G2 sale, so don't reach for the top number. Pathway 2 is the Nordic assets, repurposed for AI infrastructure. The company stated Norway's Moat Rana site got 50 MW of grid restored, with up to 396 MW applied for, and Finland has roughly 300 MW of brownfield. The engaged Pareto valuation runs $0.5 to $1.0 million per NW, and they're open to an outright sale or a partnership. Are read. Both of these are gravy, but don't treat them as the main course. Here's the soul-searching question, and we'll ask it straight. Strip away OBBBA and the Section 232 tariff wall and what's actually left of T1 Energy's moat. The company stated it runs self-assessed FIOC compliance across 5 pillars like debt, executive officers, IP, and substantial assistance. On top of that, they layered in a Singapore Evervault IP license, described as added redundancy to bulletproof the existing compliance. Think of it as a belt, and then suspenders on top of the belt. But the company's own framing says the core value proposition is tethered to regulatory compliance and policy capture, not absolute cost or technological superiority. Our read is blunt. The legal architecture is the product here. And this moat holds only as long as the policy dividends keep paying out. So know what you actually own. A compliance machine riding a policy wave, not an unbeatable technology edge. Here comes the first radar alert, and this is the most dangerous screw on the whole bridge. The company stated phase 1 of G2 still lacks $350 million to reach financial close. And here's the stopgap. They're burning balance sheet cash right now just to keep construction on schedule. How does management talk about it? They repeatedly guarantee an April close and say they've turned down higher cost options. But pay attention, they decline to disclose the structure, the source, or the ratio, none of it. The CFO's line was, quote, We just have 30 days left. Let me tell you, when a company keeps pushing the timeline but won't explain how the money actually comes in, that's when you get careful. I'll read. Until that 350 million actually lands, this is the most precarious still unbolted screw on the bridge to 2027. And if it loosens, the whole span shakes. Second radar alert, and this one's about the capacity gap. The company stated that the 2026 high end guidance reaches 4.2 GW, but do the math yourself. The signed lockdown backlog is only 3.0 GW. That middle 1.2 GW, that's merchant risk exposure uncontracted, and its pricing leans heavily on how the tariff case lands. So the high number they're waving has a real chunk that isn't in hand yet. The company itself names 3 gears turning underneath this. The Section 232 final ruling that dictates pricing power, their ability to scale up domestic sourcing, and client timing on safe harbor milestones. And here's one more thing we're watching. The company stated some first quarter shipments slid into the second quarter, calling it just a timing difference. I'll read, with that April funding deadline right next door, shipment sliding back is a signal that deserves a hard look. Step back and look at the real nature of this thing. Our take is the whole story boils down to one thing, a race against the clock for policy arbitrage. On one side is the tailwind. The company points to the OBBBA and 4-5x regulatory wall, potential upside from Section 232, and AI data centers driving power demand through the roof. On the other side is execution speed. They have to build the plants, lock the high margin contracts, and close the financing before that window slams shut. The company even borrows Musk's sentiment, the 100 GW solar push and Austin's $20 billion terafab. But mark this, those are emotional catalysts, not $1 of direct revenue for T1, so don't bank on them. I'll read, the gamble is binary: win the race to 2027 profitability, or collapse on the bridge from a funding shortfall or a policy shift. That simple. Last thing, here are the 5 hard metrics to watch over the next 3 quarters. The first 2 are the critical path, the red dials, and until they lock, everything else gets the skeptical treatment. 1. The G2 350 million funding close, the company stated April, so track whether it actually executes on time and what the final capital structure and cost of capital look like. 2. The Section 232 ruling still pending, so watch the final implementation and whether the coverage reaches both modules and cells. Then 3 operating dials. 3. Off-day conversion, can they close that 1.2 GW gap between the 3 GW backlog and the 4.2 GW guidance? 4. G1 margin trends, sequential EBITDA improvement, and whether the SG&A cuts actually show up. 5. Nordic asset monetization, real transaction pricing, and a real timeline. I'll read, until those first 2 red dials turn green, anything downstream, no matter how pretty, you treat with intense skepticism. If you like this kind of analysis, the kind that does not ride the market's mood and stays locked on industry data and hard logic, please subscribe to Value Stock Radar, hit the bell, like and share. Your support is what keeps us digging through the financials and hunting down quality names. This is Value Stock Radar. See you next time.